Hemant, good morning. For an insurance player like Kotak, who's actually looking to invest over the next 5 years, yesterday's sell-off, yesterday's panic in some of the mid-cap, small-cap names which you like, was probably a buying opportunity?
Certainly. So, yesterday's event, I think got also mixed with the expiry. And that's where maybe the reaction was larger than normally would happen on such an event. And, it's difficult to predict how the markets will behave on it going forward. So, in the near term. So, near term, you will see volatility. And wherever we are comfortable with the price in terms of valuation, I think it's a good opportunity to add, those positions in the sell-off.
Right. As far as, the overall, something like an insurance player is concerned like you, do you believe that, looking down the period of 5 years, largely the total approach towards the market changes when such an event happens?
See, what we believe is, and it will be our advice to all the investors, that whoever is looking at equity, insurance invests not only in equity, they obviously invest in equity and that both. I look at equity side. So any investor who wants to look at equity needs to have a 5-year horizon. So it's nothing so specific about insurance. And the only thing what differentiates insurance from mutual fund is that normally here client signs a longer term contract. Now you have a 5-year lock-in for the product, and typically you believe that investor will come with a 10-year horizon for the product itself, and that's where redemption pressure may be relatively less, which you typically see in a mutual fund scenario. So that's where that differentiation happens. But anyone who is looking at equity as an asset class needs to have a 5-year plus horizon, independent of what is happening today in the economy. So at insurance, as you rightly mentioned, we look with a long term. Obviously, we don't invest every position with a 5-year view, but typically we at least tend to have a 3-year view on the company. And whenever there is a short-term volatility, there's always a good opportunity to add to strong companies. Because when market is exuberant, some of the strong businesses tend to trade at a premium valuation. Liquidity tends to be dry up. So in any such panic sell-off, you get liquidity and you get favorable prices. So there are always a good opportunity to add. But still, even after yesterday's sell-off, market was at 8700. So it was above even the August levels which we've seen only 1 month back. So it's not that markets have sold off very sharply. It's a normal correction. It could have happened on any other event also as the market had risen. But still, it gives an opportunity to add with a long-term perspective.
In terms of such events like geopolitical situation that we saw yesterday where there were some concerns, markets would get scared. Investors who want to buy would just be on the sidelines till we get clarity, and that's why such a sell-off?
That's true. So what happens that it also is linked to how the market is positioned. So because of the sharp up move in the market we saw in the last 6 months, there was a lot of positions built up on the F&O side, so that indicates that leverage in the system is high. And whenever there is uncertainty, short-term players, mainly the traders, will tend to be risk averse and they will reduce their position. Long-term investors will selectively buy, but they are not going to hurry up to buy on the first day itself, because no one is clear what's happening. But if you see, you don't have too many instances where because of geopolitical situation, market sell off on a sustainable basis. So there will be near-term reactions where short-term players will sell off till the more clarity emerges. But as value starts emerging in the companies and market, long-term investors will step in. What we also understand is that some of the mutual funds are sitting on reasonable cash as an industry. Even some of the FIs are looking to buy on declines because the valuations were somewhat expensive before this correction. So any further dip, what we understand is that those kind of money will start flowing into the market. but it may take some time. So, in such scenario, it is better to phase out your investment rather than buying at one go, because events are not clear, and you can have a correction possible at the same point of time.
In terms of flows, you expect it to be vulnerable based on the news flow? Yesterday's number, of course, was impacted by the Kotak block deal, by derivatives, ICICI listing. So a lot of numbers impacted, a lot of factors impacted the numbers yesterday. But how do you expect the flow trajectory to be?
So flow in terms of two situations. One is, how the flows impacted to the funds itself. So whether the mutual funds and insurance company will see redemptions or outflows on the base of it. Now, whatever feedback we have from the market, most of the investors were looking to buy on declines. So today, I think there is a wider acceptance that equity will need to be invested with a 5-year horizon. And whenever there is a sell-off on either some economic news or geopolitical, they are always a good opportunity to buy, because buying it cheap. So there is an indication that investors will actually, put in money as the market corrects. So we don't believe that we'll see some serious redemption pressure on the back of it. Now, what the fund themselves do, as I mentioned, what the industry data says that today, mutual fund industry is sitting on a fair amount of cash. They have been investing slowly in the last few weeks because valuations were higher. So whatever flows they were getting, maybe they were adding to their cash position. So as market corrects, they will look to deploy that back into the market. Even on the insurance side, if you see, they have been sellers in the last 3-4 months. So as an industry, again, insurance should be sitting on the cash. Maybe large position might be with the industry leader LIC. Because they tend to behave in a counter-cyclical manner. And so as market corrects, what we believe is that there is going to be reasonable support from the institutional side. So what will be critical is that we don't believe, there is not going to be much pressure from the domestic side. What we'll need to monitor is more on the FI side. There again, flows will be determined more by what is happening on the, emerging markets rather than only what's happening in India. Because large part of the flows to India in the last 6 months has been more of emerging market ETFs and not so much of India-specific ETFs. So it is wrong to assume that people will start redeeming emerging market funds because there is some issue they see on the India's geopolitical side. So overall, apart from some knee-jerk reaction, we don't believe there will be on a sustainable basis outflow on the basis of this event. Now, another event which is pending is US elections, and on the back of that, there might be some volatility seen on the FI flows. Will be wrong to correlate it to only to what happened in India yesterday, but more of emerging market event, and we can get impacted by it in the month of October. So investors need to keep that in mind.
In terms of mid cap and small cap, the rally that we have seen, the optimism that was there, they are much more vulnerable to any risk.
So in terms of, when you talk of vulnerability, money will be in terms of either earnings or, valuation. Now earnings, it is too early to say whether there will be impact on the economy, and that's where the earnings, it's true. If you see what is true is that inflation in the economy is under control. RBI has room to, ease the interest rates. There is a possibility of a 50 basis point rate cut over the next 1 year's period. They are also providing enough liquidity into the system. So interest rates are coming down, which helps mid-cap as a sector, because normally, their borrowing costs are larger. Better liquidity always helps, smaller companies more. So they will be favorably impacted by it. In terms of valuation, they were running at somewhat, premium to their long-term history, but that is likely to sustain. So again, after some knee-jerk reaction, whether, earnings momentum is strong, we believe buying interest will be there. Funds will use this sell-off to increase their position in those stocks. And that's where, on a sustainable basis, we don't believe mid-caps will underperform. Till this, optimism on the economy and flows is there, mid-caps will come back after some sell-off.
Hemant, how would you look at the telecom names? We have the telecom auction, which is starting soon. Ahead of the auctions, would you take a bet on the telecom names or just avoid it because the capex is high, debt is high, and competition is quite fierce?
So obviously it will depend upon on the risk appetite of the investor. But if you see overall today, still the uncertainty on the sector is very high. Reliance Jio has just launched their service, and there are some issues going on in terms of interconnectivity, and the incumbents are responding to Reliance Jio's offer. So we don't know today how the sector will evolve in terms of the business going forward. Apart from that, now you also have uncertainty on the auction side. How much aggressive each player is going to be, and what kind of capex outlay they will have to put on that count is also not clear. So it's better to build on that sector. So as a investor, it is when the things are not clear, you may get a high return opportunity, but they are also with high risk. So in view of that, it is better to avoid the sector for the time being, and look once you have some stability coming up on the business outlook.
As far as the entire pharma or IT pack is concerned, would you look at them as a defensive play right now? Is that something which you would be considering?
So challenges in both IT and pharma in a way are different, but one factor common to them will be the rupee. And so we saw some correction, depreciation happening in rupee yesterday. But broadly the trend looks like that emerging market currencies will be stronger than will appreciate against dollar going forward, or at least remain stable. Because inflation is coming under control in India. And traditionally, there has been one of the main reasons why currency continuously depreciates. So if you take that call, then one of the main levers for their earnings growth, which is rupee depreciation, is taken out, and because of that, growth looks somewhat weaker in rupee terms. Second is, if you look at IT, then business environment looks challenging. Today, the growth rates have been brought down. But what can happen is that even going forward, margins can come under pressure. No one really, is talking that to what extent margins can correct. But the way business conditions are, we believe that margins can be under pressure going forward. So they may look good on an absolute basis. Maybe there is a down, possible to perform the market. So it is better to look at October results and then take a call rather than anticipating it. So as I mentioned, going with the theme that when conditions are uncertain, it is better to be on the sideline than wait for the clarity to emerge. In the pharma side, you cannot take a very sectoral call. Every company has their own dynamics. But what it looks like that the companies which have already large business in USA are facing pressure from FDA inspection as well as pricing pressure. Is the to establish their business in USA, which are having relatively smaller size, are benefiting from faster approvals from US FDA. So, one has to take a very, very company-specific call there and try to invest, rather than taking a very top-down view. But at least larger companies seems to be under, pressure currently, and that may sustain for some more time. So, it is, to summarize, IT looks under pressure, whereas pharma one needs to take a more company-specific approach to investing.